Hello. I want to talk to you about a crucial question right now. Where should you be putting your money in 2026? This topic requires a deep look at valuation, risk, and the discipline of patience. The market is currently expensive. I have been clear that my company, Berkshire Hathaway, is sitting on a record cash pile now approaching $392 billion, and we have been a net seller of stocks for 12 consecutive quarters. This strategy is not based on pessimism. It is based on the simple math of value. I cannot find wonderful businesses at fair prices. Everything is simply too expensive right now. If I were forced to deploy capital today, I would tell you that the three best places to put your money are likely not what you think. They are not the hype stocks, they are not the latest speculative frenzy, and they are certainly not the junk bonds that are currently masking massive risk. My core philosophy demands that I look for intrinsic value, and that value is absent from most of the stock market right now. The S&P 500 CAPE ratio is currently above 39, a level that has only been surpassed once before in history during the dot-com bubble. When assets are priced for perfection, the risk of a sharp correction is immense. You must be fearful when others are greedy, and I can tell you, others are very greedy right now, chasing that last sliver of yield or speculative growth. I ask you, are you buying a business or are you just buying a stock ticker? The first place I would put my money, and the most conservative, is a direct reflection of our massive offensive cash strategy, the safest, shortest term U.S. government debt. This is about building the foundation of a fortress balance sheet. 1. High-yielding U.S. Treasury bills, the ultimate option. I know it sounds incredibly boring. It sounds like the opposite of investing, doesn't it? But remember the critical lesson. My cash is not an investment. It is an unexercised call option on lower asset prices. It is a loaded elephant gun, and I am merely waiting for the right moment. When the general market is overvalued, the best investment is the place where you preserve capital, earn a safe return that actively fights inflation, and maintain instant, massive liquidity for when the real opportunities arrive. This strategy is entirely dictated by the current Federal Reserve policy. Data point 4, the Federal Reserve Fed funds rate, November 2025, is 5.75%. Because the Federal Reserve has kept the short-term cost of money this high to wrestle inflation to the ground, short-term U.S. Treasury bills, the safest asset in the world, backed by the full faith and credit of the U.S. government, are currently yielding close to 5%. This is a brilliant risk-free proposition. You take virtually zero credit risk, you more than beat the inflation tax, and you maintain complete instant optionality. Compare that to the frightening credit market. Data point 5, spread between high yield and Treasury bonds, November 2025, is 350 basis points. Historically tight. This tight spread means you are only getting 3.5% more yield to take on the massive risk of a junk bond, which is facing a forecast default rate of 6.5% in 2026. The T-bill pays you 4 to 5% for taking zero credit risk. It's an easy choice for any rational investor. I simply will not risk 95% of my capital for an extra 3% of return. The math doesn't work. You must never follow the crowd. The crowd calls this parking money. I call it preparing for war. Hit the like button if you currently hold high-quality T-bills or T-bill funds. Comment your safe yield below. Let's share what the best safe returns are right now. My question for you is, are you prioritizing capital preservation over a chase for a risky marginal yield? The second area for investment is where my longtime partner Charles Munger and I spent decades focusing: businesses with an enduring competitive advantage that require very little capital to grow. This is the definition of a high-quality asset: businesses with low capital intensity and pricing power. The inflation hedge, I am looking for businesses that have a durable moat, a special protected competitive advantage that allows them to raise prices without losing customers to a competitor. This is the only true sustainable way to beat inflation over the long run. When inflation runs persistently hot, as I suspect it will due to massive governmental debt, companies that require huge amounts of capital investment just to maintain their existing infrastructure, like railroads, capital-intensive manufacturing, or certain utilities, struggle to keep up with rising costs. Their returns on capital suffer. I prefer a business that sells a product or service people love, need, or rely on, and can charge a little more for it every year without complaint. Think of the historical success of firms with powerful consumer brands or unique distribution networks. Their return on invested capital is phenomenal because they don't have to sink all their profits back into concrete and steel. The current economic indicators reinforce the need for pricing power. Data point 8, Consumer Confidence Index Novena 2025 is 95.5, falling from 105 in Jan 2025. When consumer confidence falls, people cut back on unnecessary purchases, but they rarely cut back on essential branded purchases they trust. A slight price increase on a consumer staple, a critical software service, or a trusted financial product is accepted because the perceived value to the consumer remains high. These companies are resilient. Critically, these are businesses that do not need to rely on the shaky corporate credit market, which is clearly headed for trouble. Data point 1, U.S. corporate debt to GDP ratio, Q3 2025 is 52.8%, record high. I want companies that are not dependent on cheap debt to survive the coming downturn. I want companies that are cash-generating machines that can fund their own growth. When the junk bond meltdown of 2026 hits and the cost of debt soars, these fortress companies will see their stock prices temporarily fall with the rest of the market's panic, giving you the rare opportunity to buy a wonderful company at a fair or even wonderful price. You are buying quality and you are buying it safely. Value is always greater than hype. The hype is in the companies that promise the moon but have an empty balance sheet. The enduring value is in the quiet, dependable fortress businesses that generate consistent cash flow. Subscribe now to the channel and hit the bell notification for true risk signals. We need to be prepared for the change in the cycle. My question for you is, does the business you own have a durable moat that allows it to raise prices when inflation hits? The third place I would put my money is not defined by a sector, but by a strategic opportunity that emerges only during financial contractions. The selective purchase of high-quality companies that have been unfairly punished. 3, select high-quality fallen angels, the panic opportunity. Every panic creates two kinds of victims: the companies that deserve to fail, the heavily indebted, speculative ventures, the junk bonds, and the companies that were simply caught in the crossfire of market fear. I am only interested in the latter. These are the fallen angels. These are high-quality companies that possess a strong, fortress-like balance sheet, an unassailable brand, and an excellent long-term economic model, but whose stock price has been crushed because of a sector-wide liquidity panic, a temporary operational hiccup, or a major one-time political or legal event. They are cheap because the market is panicking, not because their intrinsic value has fundamentally deteriorated. It is crucial to understand the source of the coming panic to identify these targets correctly. Data point 7, private equity's share of U.S. corporate debt 2025 is 45%. The high concentration of debt in private equity hands, which is highly leveraged, means that the corporate debt bubble, the junk bond meltdown of 2026, will lead to sudden, severe losses among speculative borrowers. This panic will spill over, infecting the entire stock market, and even good companies will be unfairly punished by generalized selling. This contagion is precisely where I would deploy my ready cash. Think back to the 2008 financial crisis. When everyone was running from the banks, I stepped in to back institutions like Goldman Sachs. They were a high-quality company, temporarily paralyzed by the market-wide fear. That investment made enormous returns, precisely because the market was mispricing the risk. This strategy requires two things: a clear, rational definition of intrinsic value and the emotional fortitude to be aggressively greedy when others are paralyzed by fear. The principle of preservation of capital as priority number 1 actually dictates this move. Why? Because you are ensuring your capital is preserved by acquiring assets with a massive margin of safety, and panic-driven market prices are the best way to get that margin. A high-quality company trading at 2/3 of its clear intrinsic value is a gift that you must have the liquidity and the discipline to accept immediately. Please share this video with a friend who is overpaying for growth stocks. They need to understand the power of a discounted purchase. My question is, do you have a list of high-quality businesses you love and the exact low price you would buy them at if the market panic began tomorrow. The true secret to success in 2026 is not about what you buy now, but about when you buy and the quality of the capital you are buying with. This requires the integration of all three strategies. First, you need to have your high-yielding T-bill cash ready. This is your patient, defensive, high-quality reserve. Second, you need to have identified your low capital intensity businesses. These are the long-term compounding machines that will beat inflation and require less capital, which is getting increasingly expensive. Third, and most important for the short term, you need to have a predetermined buy list for the fallen angels. This is your offensive plan. The market is set for a major correction. We have too much debt, valuations are too high, and the risk premium is too low. The junk bond meltdown of 2026 is the mechanism for the correction. You must not follow the crowd. The crowd will be in a state of shock, selling everything indiscriminately. By positioning your money in these three places, high-quality T-bills, resilient low-capital businesses, and a pre-vetted list of fallen angels, you are guaranteed to preserve your purchasing power today, and you are perfectly prepared to play offense when the buying opportunity of the decade arrives. You will be the one deploying cash when others are raising it. That is the definition of true financial strength. I want to spend a moment on the crucial link between the credit environment and your stock buying strategy. The two are intertwined, and the credit market usually breaks first, signaling the stock market's eventual fall. The high-yield bond default rate is forecast to be 6.5% in 2026, according to Moody's and S&P Global Ratings. This is data point 2, and it is a massive increase. This is the financial equivalent of a warning shot across the bow. When defaults hit 6.5%, there will be serious stress on companies, particularly those heavily leveraged by private equity firms. This will create a contagion effect as banks and investment funds face losses, leading to forced selling of liquid assets, which means stocks. This is why your fallen angel list is so important. When stocks fall, they often fall across the board without regard for quality. Your job is to ignore the general panic and focus only on the intrinsic value of the businesses you want to own. The key to navigating this is remembering the core lesson. Value is greater than hype. The hype is telling you to buy the latest speculative stock. The value is telling you to wait patiently with safe, high-yielding T-bills for the price of a truly wonderful business to fall to a rational level. Do not be the timid investor who sits on cash that is losing value to inflation and then misses the crisis buying opportunity out of fear. Be the disciplined investor who uses T-bills to fight inflation and who uses the fallen angel checklist to capitalize on panic. I urge you to take these warnings seriously. The current environment is one of extreme danger for the unprepared and extreme opportunity for the prepared. My strategy has always been simple. Be patient, wait for the perfect pitch, and have the capital ready to swing powerfully when that pitch arrives. Right now, the pitches are either too speculative or the price is too high. The three places I mentioned are all about waiting safely and preparing intelligently. Preservation of capital is priority number 1. Ensure your cash is safe and fighting inflation. Identify your high-quality targets. Wait for the market to give you a massive discount. I ask you now to smash the like button if you are sitting on cash and waiting for a bargain. Subscribe to the channel and hit the bell for more warnings like this. Comment Fallen Angel if you are preparing your buy list. And please share this video to 3 friends you care about. If you want a free guide, you can get my margin of safety guide in the description below. Stay safe. God bless. My final question for you is, which of the 3 places I mentioned, T-bills, low capital businesses, or fallen angels, are you going to focus on first to prepare for 2026?